Okay, let's dive into this. Welcome back to The Explainer, everyone. Today we're cutting straight through the noise for a highly structured teardown of Talos Energy, ticker symbol TALO. We're zeroing in on their first quarter of 2026. Look, if you track the offshore energy sector, you already know it's a beast. It requires massive capital, and lately, the macroeconomic volatility has been off the charts. But hidden right inside all that chop, Talos is writing a fascinating story of financial engineering and ruthless operational discipline. I want to hook you right out of the gate with this exact number, $135 million. Over the last 4 quarters, this is the amount of capital Talos has returned directly to its shareholders. By aggressively and consistently buying back their own stock, they've actually shrunk their outstanding share count by roughly 7% in just a single year. You know, that's not just some accounting rounding error. That is a massive, deliberate reduction of their equity base. It means every single share you hold now claims a significantly larger slice of the company's cash flow pie. So how are they funding all of this? Well, let's look at the roadmap.
Here's exactly how we're going to break this down today. First, we'll get a TALO market snapshot. Second, we'll dig into the Q1 2026 financial performance. Third, we'll cover their operational highlights. Fourth, we're looking at the capital allocation strategy. And finally, number 5, navigating market volatility.
All right, jumping right into Section 1, TALO Market Snapshot, Choppy Waters.
Now, what's really interesting about this slide is the wild divergence in market sentiment right now. When we look at predictive AI models from Stock Traders Daily, the signals for Talos are literally all over the map depending on your time frame. Short term, over the next 1 to 5 days, it's totally neutral. Push that out to 5 to 20 days, and the midterm signal actually goes weak, indicating some serious oscillation and mid-channel chop right around that mid-$14 range. But check out the bottom row. The long-term signal, looking 20 days out and beyond, flashes strong, with an upside resistance target pushing all the way to $17.01. So the crucial takeaway here is that while short-term traders are out there battling over pennies in a volatile macro environment, the underlying data points to a really solid long-term foundation. To grasp why that long-term outlook is so strong, we've got to look under the hood.
Moving to Section 2, Q1 2026 financial performance, the hard numbers. For the first quarter, their execution was just incredibly robust. They actually blew right past their own production guidance. Just look at the pure cash-generating power they've got going on right now. $293 million in adjusted EBITDA for a single quarter. But the number that really matters to investors is that $113 million of adjusted free cash flow. Free cash flow is absolutely the lifeblood of any E&P company, right? It's the cash left over after you pay for all the capital expenditures needed to maintain or expand the asset base. So clearing $113 million in just 3 months, that gives a management team a tremendous amount of optionality.
And that leads us straight to this specific metric, 13.95%. This is their free cash flow yield. When you stack the cash they're throwing off against their $2.41 billion market cap, you get nearly a 14% yield. Guys, in an era where so many companies are struggling to generate any real cash return on their equity, Talos is comfortably sitting in the double digits. It is a striking piece of evidence showing their internal financial health. So, how exactly are they squeezing out this level of profitability?
Let's move to Section 3, Operational Highlights, Efficiency at the Helm.
To really get it, let's anchor our understanding to the C-suite's mindset. CEO Paul Goodfellow made it crystal clear on the Q1 earnings call that these numbers weren't an accident, and they weren't just a lucky break with favorable oil prices. He stressed that their free cash flow enhancements were driven by grinding out broad-based operating cost reductions, pushing margin improvements, and driving intense capital efficiency spanning their development, operations, and plugging and abandonment activities. Get this. They actually locked in over 40% of their entire 2026 cost-saving targets in the very first quarter. They are literally trimming the fat everywhere they can.
Let's put some specific metrics to that operational success. During the quarter, they invested roughly $120 million into exploration and development. But look right there at that second bullet, a super low 41% reinvestment rate. That means they're only putting 41 cents of every dollar of operating cash flow back into the dirt to maintain the business. This is definitive proof that they're doing more with less. On top of that, their upcoming 2026 development projects boast break-even costs way down in the $30 and $40 per barrel range. Roll all of that together, and their overall corporate free cash flow break-even sits in the low $50 West Texas Intermediate range. Simply put, as long as oil stays above the low 50s, Talos is making pure profit.
Which brings us to Section 4, the capital allocation strategy. Better, not bigger.
So, Talos runs on a highly disciplined dual mandate.
On one side, you have reinvestment in the business, which, as we just saw, is highly efficient at that 41% rate. On the flip side, their official framework dictates returning up to 50% of annual free cash flow right back to shareholders. And in Q1 specifically, they leaned hard into this. They allocated 34% of their adjusted free cash flow, which is about $38 million, strictly to share repurchases. They are not sitting around hoarding cash. They are systematically buying out their own investors, which drastically increases the value of the shares that remain.
Add to that, the flexibility of their balance sheet is turning into a massive strategic weapon. CFO Zach Daly noted that the company's financial health provides them tremendous optionality going forward. A huge potential catalyst on the horizon is the refinancing of $1.25 billion in second lien notes. These notes are actually trading above par right now, and some are becoming callable. Management explicitly confirmed that dealing with these bonds is front and center on their radar. If they can refinance that debt at a lower rate, it would drastically slash their interest expense, unlocking even more free cash flow to funnel right back into their shareholder return framework.
Finally, let's look at Section 5, Navigating Market Volatility, Insulating the Business. And this brilliantly illustrates the strict discipline of the management team here. During the quarter, global geopolitical events, including the war in Iran, caused some massive spikes in volatility in the oil curve. Now, it is incredibly tempting for oil executives to see a price spike and immediately start greenlighting expensive, risky new projects. But CEO Paul Goodfellow flatly stated, no way. They will not chase the backwardated oil curve. Remember, a backwardated curve means short-term prices are high, but futures prices are lower. Goodfellow insists their strategy remains completely unchanged. They are sticking to their strict thresholds, only investing in projects that have high resilience and low break-evens through an entire market cycle.
But hey, they don't just rely on operational discipline, they use hard financial derivatives to protect their downside. Let's break down their risk management strategy for Q2 of 2026. First off, they've locked in 19,000 barrels per day on a fixed swap at $66.90. Bam! That revenue is guaranteed. Then, they have another 19,000 barrels a day projected by a collar strategy, setting a hard floor at $62.37, while still allowing them to capture the upside all the way to $77.45. This hedging profile means that literally, even if global oil markets crash tomorrow, Talos has locked in the exact revenue they need to cover their low 50s corporate break-even. They've essentially built a financial fortress around their balance sheet.
So here's the big question you should take away from this explainer today. As we look out over the next few years, will Talos Energy's relentless disciplined capital framework, this total obsession with being better not bigger, continue to outperform the inherent volatility of the offshore energy market? Look, they've shown they can execute in choppy waters, they're heavily reducing their share count, and they're maintaining those incredibly low break-evens. The real test is going to be their consistency over the next full cycle. Thank you so much for joining me for this teardown, and I will catch you in the next explainer.